Picture this. It is Monday morning. Sunlight spills across the city as millions of small traders around the world open their laptops. A hot cup of coffee steams next to them as they stare at the screen, watching red and green candles flicker endlessly. In that moment, each one believes they hold the chance to change their lives. They believe that if they are patient enough, if they read the news carefully, if they draw the right trend lines, they will come out ahead. This belief is not new. It has fueled an entire industry. Trading courses, financial forums, endless books promising to teach you how to get rich in the stock market. Year after year, the crowd is pulled into the game, hoping that this time will be different. But the cold truth is, nothing ever changes. Wave after wave of traders step into the arena, only to repeat the same cycle, losing money, burning out, and walking away in frustration. On Wall Street, they call this easy money because the false beliefs of the majority are the raw material that keeps the market alive. The crowd does not realize that the market was never designed so everyone could win. It was built for a small group of the powerful to survive and profit on the destruction of everyone else. One of the most common beliefs is that prices move based on news. Good economic data will push prices higher, bad data will drag them down. It is simple, logical, and comforting, but it is also a lie. Think back to the times when the United States released the non-farm payrolls report. A retail trader sees stronger than expected numbers and rushes to buy the dollar, convinced it is about to soar. But minutes later, the dollar sinks instead. Confusion sets in and the trader thinks the market is insane. The market is not insane. It is the trader who does not understand the game. News is just a trigger. The big players are already positioned long before the announcement. They use the release to lure the crowd into the wrong direction, feeding off their orders, and then flip the market the other way. News does not guide the market. It is a tool used to herd the majority. When news fails them, retail traders fall back on charts. They draw trend lines, mark support and resistance, and convince themselves the market respects those lines. Once again, they fall into a trap. Thousands of traders see the same support level. Thousands of stop losses sit just beneath it. For the small trader, this looks like a place to buy. For Wall Street predators, it looks like dinner. They push the price down, sweep the stops, and then send the market back in the original direction. The crowd thinks charts are weapons. In reality, charts are maps that show exactly where they are hiding their money and the strong use those maps to take it. Perhaps the most dangerous belief of all is in fairness. A retail trader sits behind a screen with a few $1,000s in an account and imagines he is playing the same game as institutions managing billions. He thinks the market is democratic. It is laughable. Big banks do not trade on gut feeling. They have access to order flow data you will never see. Hedge funds employ armies of quants who build models that process every tick in milliseconds. Market makers can see hidden liquidity and adjust spreads at will. And central banks can wipe out entire trends with a single policy decision. You think you are on equal footing with them because you look at the same chart? Wall Street calls that the sweet illusion of the weak. Many new traders cling to quotes from Warren Buffett. Be patient, hold for the long term. They confuse value investing with short-term trading. Buffett did not become rich just by being patient. He became rich because he had power, information, and nearly unlimited access to capital. You, on the other hand, when you cling to a losing position and hope the market turns around, you are committing slow suicide. The market does not care how patient you are. It will take everything you have and leave you behind. Why do these false beliefs persist? Because they are comfortable. The crowd wants simple reasons to explain chaos. They want to believe the market is fair, that following a few basic rules will make them winners. They need a story to hold on to. But the market does not care about stories. It only cares about money flow. And money always flows from the weak to the strong. The majority buy at the top, sell at the bottom, and place their stops where they are easiest to hunt. They are the fuel that powers the system. Wall Street does not need them to win. Wall Street needs them to keep playing, to keep dreaming, to keep depositing money, and to keep losing. That is why after decades, the failure rate of small traders has never changed. To survive, you must strip away every false belief. Accept that the market is not fair, that you are not playing under the same rules as the giants. You cannot rely on news, you cannot trust a few lines on a chart, and you cannot believe that patience alone will save you. You must learn to see the market with a predator's eyes, not a victim's. You must understand that prices move not for the reasons you hope, but for the hidden agendas of those who hold power. If you do not grasp this, you will forever remain part of the majority that the market devours. The market is ruthless, and the brutal truth is that the majority never win. They live by false beliefs, and they die by those same beliefs. Survival begins with destroying those illusions. Only by accepting this cold reality can you step outside the herd and move closer to the small minority who actually make money. The real players behind price movements. When a small trader sits in front of the screen and watches candles climb and fall, he usually believes that the market is simply a collective arena where millions of individuals buy and sell, creating supply and demand. That belief sounds logical, even beautiful, but it is completely wrong. Prices in financial markets are not the outcome of a fair, free market where everyone has the same weight. Prices are shaped, directed, and often distorted by a very small but extremely powerful group. They are not playing by the same rules as you. They are the ones writing the rules. Who are they? It begins with the market makers, the gatekeepers of liquidity. When you press buy or sell, your order does not magically float into cyberspace and get matched with someone else. It goes through the hands of market makers who are always ready to stand on the opposite side. They decide when to widen the spread to squeeze extra profit, when to nudge prices just enough to trigger thousands of stop losses at once. Then come the big banks, the whales of this ocean. JP Morgan, Goldman Sachs, Citi, Barclays. These giants do not only trade for clients, they trade for themselves with capital large enough to shake entire markets. They know exactly where clusters of orders are waiting, where liquidity pools are concentrated. When they move, the market shudders. You see a breakout, they see a liquidity pocket and drag price into it to collect. Next are the hedge funds. Think back to George Soros and the collapse of the British pound in 1992. That was not a retail trader riding a trend. That was billions in capital, combined with vision and execution, enough to challenge the Bank of England. Soros was not unique. Today, hundreds of hedge funds run complex algorithms, pulling in data by the millisecond, scanning market sentiment from Twitter to financial news, all to gain an edge that retail traders cannot even comprehend. And then there are the players most retail traders never think about. High-frequency traders, the HFTs. They do not care about candlestick patterns or macro reports. Their weapon is speed. Their servers sit right next to exchange data centers, with fiber lines optimized to shave off nanoseconds. They do not need to predict long-term trends. They just need to front-run your order by a fraction of a millisecond and extract profit. Your trade is a grain of sand, but billions of those grains feed their empire. At the top of the hierarchy stand central banks. One statement from the Federal Reserve Chair can erase trillions in global value within minutes. Interest rates, quantitative easing, currency interventions, these are not just policies, they are levers that move the entire financial system. When the Fed cuts rates, cheap money floods markets, stocks explode upward. When they tighten, markets contract, and those who stay too long get crushed. Retail traders obsess over a decimal in the CPI, but central banks have already been positioned months, sometimes years, ahead. If you are a small trader, you must understand this. You are not facing a free market. You are on a battlefield against opponents with near absolute power. They do not guess the direction. They have the capital, the data, the speed, and the tools to bend direction in their favor. This is why most retail traders lose. Not because they lack knowledge or discipline, but because they believe they are playing a fair game. The truth is that the game is designed to drain them. They are the fuel, the fresh money that feeds the system. Prices do not wander randomly. Prices move where the real players want them to move. The stop-loss hunting game. If there is one truth most retail traders never want to face, it is this. The market is designed to take money from them. Nowhere is this reality more brutal than in the stop-loss hunting game. Picture this. A small trader studies the chart, draws a neat resistance line, and convinces himself that if price breaks through, it will surely run higher. He places a buy order just above resistance and a stop loss right below it. He feels disciplined, proud that he followed the textbook rule of risk management. But only minutes later, price dips just far enough to hit his stop, kicking him out of the trade, before reversing and rallying exactly in the direction he predicted. He is left watching helplessly, his position liquidated, his confidence shaken. This is not random. This is a carefully orchestrated game. The truth is that large players know exactly where most retail stop losses are placed. Human psychology is predictable, and traders behave in patterns. Everyone sees the same support and resistance, the same previous highs and lows, and naturally, everyone clusters their stops in the same zones. To the big players, these clusters of stops are treasure maps. They represent liquidity waiting to be harvested. The mechanism of stop-loss hunting is simple, yet devastatingly effective. Price is pushed just far enough to trigger a wave of stops, unleashing a flood of sell or buy orders from retail traders. That sudden burst of liquidity provides the perfect fuel for institutions to build their positions. Once the stops are cleared, the market resumes its true direction, leaving retail traders out of the game, often chasing after the move they had predicted but were forced out of. There are classic scenarios that play out again and again. One of the oldest tricks is the false breakout. Price breaches a major level, luring in eager buyers or sellers, while simultaneously triggering the stops of those positioned the other way. But instead of following through, the breakout collapses. Buyers are trapped at the top, sellers are already stopped out, and the hunters pocket the profits from both sides. Another scenario is the shakeout within a strong trend. As an uptrend extends, confidence grows and retail traders pile in. But beneath the rising candles lies a layer of clustered stops, usually just under minor swing lows. One sharp dip sweeps through those stops, creating what looks like a sudden sell-off. Once the weak hands are flushed out, the dominant trend resumes, leaving small traders staring at the screen, unable to re-enter. There are also more sophisticated traps. Price consolidates in a tight range, building tension as both sides commit positions. When liquidity is dense enough, the hunters strike with a fake breakout in both directions. First, one side is wiped out, then the other, until the field is cleared of retail participants. Only then does the market pick its true direction. By the time the move begins, the crowd has already been burned and sidelined. Stop-loss hunting exists because the market needs liquidity. Big players cannot move billions of dollars without someone on the other side. Retail stop-losses provide that counterparty flow. They are not accidental victims. They are the very fuel the system feeds on. Just like schools of small fish attract predators in the ocean, clusters of retail stops attract the sharks of Wall Street. The sharks do not hate the minnows. They need them to survive. This game is not new. It has existed for as long as markets have. What has changed is speed. With modern technology, algorithms, and high-frequency trading systems, stop runs happen faster and sharper than ever. A clean sweep of retail stops can occur in seconds before an individual trader even realizes what happened. By the time he tries to react, the move is already gone. The greatest lesson for a small trader is not to avoid using stop losses, but to understand that stop losses are targets. If you place them where everyone else does, you are serving your order on a silver platter. If you chase the most obvious breakout level that the entire market is watching, you must ask yourself whether you are joining the winners or simply walking into a trap. The market is a battlefield, and stop losses are not just protection, they are prey. If you do not understand the stop-loss hunting game, you will forever be the hunted, never the hunter. Liquidity, the lifeblood of the market. In the world of finance, there is one concept rarely discussed in mainstream books, but absolutely essential to understanding the true nature of every price movement. That concept is liquidity. If you ask a beginner what makes markets move, he will say news, macroeconomics, technical analysis, or investment flows. But if you ask a seasoned player on Wall Street, the answer will be simple and cold: liquidity. Without it, the market is like a body without blood. It collapses instantly. Liquidity is the ability to buy or sell an asset without significantly changing its price. It is the smoothness of the flow, the bridge between buyers and sellers. A highly liquid market is like a fast-moving river. You can dive in, swim out, and leave no trace. An illiquid market is like a shallow puddle. Step into it, and the entire surface ripples. For the small trader, liquidity often feels irrelevant. With a few $1,000s or even a few 100,000, you can enter or exit positions without shifting prices. But for large institutions, it is an entirely different story. When you want to push hundreds of millions into a position, you need an ocean of liquidity. Without it, you end up moving the price against yourself. This is why the big players are obsessed with liquidity. It is not just the market's blood, it is their own blood. Now look at the true structure of liquidity. Who provides it? The first layer is the market makers. They are like constant blood pumps, ensuring that whenever you want to buy, there is someone to sell to you, and whenever you want to sell, there is someone to buy from you. But they are not charities. They profit through spreads, and they decide when to tighten or loosen liquidity. When conditions are calm, spreads are razor thin. When panic strikes, spreads widen and blood stops flowing. Small players often die during those moments of suffocation. Next are the hedge funds and banks. They do not just participate in markets, they control the flow. When they inject capital, liquidity explodes and prices surge. When they pull out, liquidity dries up and markets collapse. Every boom and every bust begins with a shift in global liquidity flows. In 2008, the US stock market plunged not because of one bad headline, but because system-wide liquidity vanished. Without blood, the global financial body nearly flatlined. Liquidity is also a weapon. You think a breakout above resistance is a sign of growth, but in reality, it may just be a trigger to attract liquidity. As price pushes higher, traders rush in, placing buy orders and stop losses just below. That creates a perfect pool of liquidity. Big players can then drive the price down, sweeping stops and accumulate at bargain levels. The move is not about news. It is about liquidity games. A classic mistake of retail traders is believing they are following the trend. In truth, most of the time, they are simply following liquidity. Once big money has already flowed in and driven prices higher, liquidity looks abundant. The crowd piles in, convinced the trend will last forever. But when those who control the flow decide to pull blood out, the crowd realizes too late that they entered at the very moment the veins ran dry. Liquidity also defines the difference between markets. A large cap stock in the S&P 500 trades tens of millions of shares daily, offering thick liquidity that allows you to buy or sell without moving price. A penny stock, on the other hand, can be manipulated with just a few $100,000. This is why sharks love hunting where blood is thin. With just a little pressure, they can move the entire market. But liquidity is not just numbers on a screen. It is psychology. In moments of panic, even the deepest markets can dry up. In 2020, when the pandemic erupted, U.S. Treasuries, considered the safest asset on Earth, faced a liquidity crisis. Buyers vanished. Sellers lined up to dump. It was proof that liquidity is not a constant, but a collective state of mind. For the small trader, the biggest lesson is to understand how this blood flows. Do not just look at charts. Ask yourself, where is liquidity right now? Who is providing it? Who is draining it? And when might it run out? If you trade only based on candles or economic numbers, you are ignoring the most vital element, whether the market still has blood to sustain the trend. Liquidity is survival. It not only fuels price movement, but also decides whether you survive or get washed away. On Wall Street, the real question is not just where is price going, but where is the blood flowing? Because in the end, markets do not move for lofty reasons. They move with the flow of blood called liquidity. The market is a place where money flows from the many to the few. Imagine a giant casino placed right in the middle of Wall Street. The lights shine bright, the tables stretch endlessly, and millions of players walk in every day. Each of them believes they are smart, they have a strategy, and they are destined to win. But behind the curtains, the real masters of the game do not rely on hope. They write the rules, control the cards, and patiently wait for the crowd to make mistakes. In the end, the chips flow from the pockets of the many into the hands of the few. That is what financial markets truly are. They are not designed for everyone to win. They are designed so that most will lose and a small minority will take the spoils. The first reason why the majority always lose lies in herd psychology. Human beings are wired to seek comfort in the crowd. When they see prices rise, they are afraid of missing out and rush to buy. When prices fall, fear takes over and they sell in panic. The cycle repeats endlessly, buying at the top and selling at the bottom. This pattern has been consistent for centuries, regardless of how technology or knowledge evolves. The second reason is the illusion of control. A new trader often believes that a few technical tools, a couple of books, and enough effort will allow them to beat the market. But the market does not care about fairness or effort. It cares about liquidity and flows of capital. When the majority place their stop losses in the same place, that level becomes nothing more than bait for predators. The third reason is impatience. The crowd wants to get rich quickly. They cannot wait. They jump in and out of trades constantly, while the few sit silently and wait for the perfect moment. Money flows from the impatient to the patient. That is a rule that never changes. The minority does not need to predict the market perfectly. They only need to understand the behavior of the majority. When prices break above a resistance level, the crowd rushes in, convinced that a new trend has started. The big players allow the price to move a little further, then slam it down. Stop losses get triggered, waves of selling cascade through the market, and at that exact moment, the few quietly accumulate at bargain levels. Or take the opposite scenario. In panic phases, when bad news floods the headlines, small investors dump everything in fear. The few see blood in the streets as an opportunity. They buy when everyone else is running. Months later, when the market recovers, the transfer of wealth is complete. The truth is simple. This game never ends. The majority react emotionally, while the minority patiently exploit those reactions. Money in the market never disappears. It only changes hands. When a retail trader blows up their account, the money does not evaporate. It goes straight into the account of someone more disciplined, better informed, or simply stronger. This cycle has repeated through history. During the dot-com bubble of 2000, millions of retail investors poured money into tech stocks, convinced that the internet would make them rich. When the bubble burst, most were wiped out. But funds and insiders who sold early kept the profits. The money shifted from the crowd to the few. In 1929, the stock market collapsed and millions of Americans lost everything. But those who held cash and waited for bargains scooped up assets at rock-bottom prices. The financial crisis of 2008 was another massive transfer. Ordinary people lost their homes, stocks crashed, yet institutions with liquidity bought at the bottom. A few years later, they were wealthier than ever. In 2020, when COVID-19 hit, the crowd dumped everything and ran for cash. But the big players quietly bought blue chips and bonds. By 2021, they had booked astronomical returns. Every crisis is a blood transfusion from the panicked many to the calm few. For a small trader, the lesson is not that the game is rigged beyond hope, but that the rules must be understood. The market will always move money from many hands to a few, but you can choose not to be default prey. First, abandon the illusion that you can win with a couple of indicators or the latest YouTube strategy. This is not a technical puzzle. It is a battlefield of psychology and liquidity. Second, learn to think against the crowd. When the herd is euphoric, ask yourself whether the minority is preparing to sell. When the herd is terrified, ask whether the minority is buying. Third, embrace patience. The few do not chase trades every day. They know that true opportunities come only a handful of times a year, but those moments can make a fortune. Wall Street lives on the blood and money of the majority. It is not a place of fairness. It is a machine that constantly redistributes wealth, taking from the impatient and handing to the patient, taking from the gullible and rewarding those who understand the game. To survive, a trader must accept this truth. Do not dream that the market will ever treat you fairly. It will not. But if you learn to think like the few, you can avoid being consumed by the crowd. And perhaps, in time, you might sit at the table with them. Because in the end, the market has one immutable function: to transfer money from the many to the few. The painful truth for small traders. When a small trader steps into the market, deep down, they always believe they can be the exception. They believe that if they work hard enough, if they are smart enough, if they dedicate enough hours, sooner or later they will crack the code to success. They believe they will not repeat the mistakes of others, that somehow they will avoid the fate of the countless traders who failed before them. Yet, the harsh truth is the complete opposite. The market has no mercy for dreamers. It does not care about your ambitions, your effort, or your determination. The market only cares about one thing: who will lose money so that someone else can gain. And the painful truth for most small traders is that they will inevitably become the liquidity providers, the losers who fund the survival and profits of the few. The market has never been a fair playing field. It does not run on morality or hard work. It runs on capital, control of information, and the ability to manipulate the psychology of the crowd. A small trader with a few $1,000s in their account, armed with free indicators downloaded from the internet, is simply not in the same league as institutions deploying billions of dollars with access to real-time order flow, cutting-edge algorithms, and inside connections. What most newcomers refuse to admit is that from the very first trade they place, they are entering a game where the opponent has every possible advantage. Losses for small traders do not just come from a lack of market knowledge. They come from within. Greed drives them to chase prices at the top. Fear pushes them to dump positions at the bottom. When the market rallies, they believe opportunity is knocking and pile in, unaware that the smart money is already distributing and preparing to exit. When prices collapse, they panic and cut positions at the very moment the strong hands are stepping in to accumulate. Again and again, their emotions are harvested as raw material to keep the machine alive. They become the prey in a never-ending cycle of hunting and slaughter. The problem is magnified by capital. For a hedge fund with billions under management, a 20% drawdown is an entry on a risk report, a manageable part of the business model. For a small trader, the same percentage can wipe out the account entirely. With thin capital, every trade feels like a do-or-die event. The pressure builds, emotions flare, and rational decision-making evaporates. Small traders bet too big, hoping one lucky trade will change everything. But that fantasy is exactly what accelerates their downfall. The truth is that the greatest enemy of the small trader is not the market itself. The market is simply a machine that reflects supply, demand, and mass psychology. The true enemy lies inside. They do not lose because they lack indicators. They lose because they lack discipline. They do not lose because they fail to read the news. They lose because they cannot control greed. They do not lose because the market is too complex. They lose because they cannot wait. Overtrading, oversized positions, chasing rumors, copying other people's signals. These behaviors all stem from the inability to control oneself. In the end, small traders self-destruct long before the market has a chance to destroy them. The market is like a mirror that reflects your truest self. If you are greedy, it will strip you bare. If you are fearful, it will crush you. If you are disciplined and patient, it will reward you with opportunities. Every trade is not just a wager on price direction. It is a test of character. And most small traders fail not because they are not intelligent enough, but because they cannot conquer themselves. Escaping the fate of the crowd is possible, but it requires a total shift in perspective. You cannot continue clinging to the illusion that there is some magic formula that will guarantee victory. You must accept that small losses are part of the game, that sometimes the best decision is to do nothing, that the real question is not what does the indicator say, but where is liquidity, who is providing it, and who is harvesting it. Success in trading is not built on a few lucky trades. It is built on discipline repeated over years. The painful truth is that most small traders will bleed out and eventually quit the market. But the good news is that you do not have to be one of them. You can choose the harder, lonelier, but ultimately more rewarding path, the path of the few. To walk that path, you must first have the courage to face this brutal reality. Hearing this may feel heavy, but understand this. It is the first step to transformation. If you cling to illusions, you will remain prey. If you face the truth, you begin the journey toward becoming a predator instead of the hunted. The market will never hand out rewards. It will only transfer money from the unprepared to the prepared. And the only question left is, will you remain the prey or will you change to become the hunter? If you are serious about building the right mindset, learning to control emotions, and breaking free from the traps that destroy most traders, subscribe to Trading Mindset Lab right now. This is not just another channel. It is a place designed to sharpen your psychology, refine your strategy, and prepare you to survive and thrive in the brutal world of trading. The time to act is not tomorrow. It is now. The choice is yours.